Hi, everybody. This is a video in continuation of our initial video on cost of capital, where we spoke about the different types of capital, where we differentiate between equity versus a debt and uh, kind of highlighted the differences between the two. Um, I just wanted to make sure, that you understand the relevance of a corporate finance manager, such as a you and an I, to calculate the cost of capital. I mean, why in the on earth is there a need to calculate something called as cost of capital? Um, I'm going to take you to pretty much the same discussion that we had in that. Remember, we discussing a decision by the business, such as a Tata Group, to invest a massive amount into battery plant. And you say that's an investment decision where you have a big investment being made by one of the businesses. The role of cost of capital, and that's why we are going to devote so much time into our course in corporate finance, is to evaluate the efficiency of this decision. Meaning thereby, without an investing decision, financing decisions have no role to play. And I think this is what I had highlighted also, in my previous video. Now, I want to kind of just go a level deeper into what do we understand by the connect between the financing decision versus an investing decision. So what I've given as here as a very simple example is no hi-fi stuff. So imagine it's a 3-year project. So a business such as a Tata Group have an opportunity to invest rupees 35. Now, this could be a $35 billion, million dollar, whatever, in a project which will generate a one-time cash inflow at the end of year 3 worth 67. Obviously, in a real life situation, you will have projects which are much longer. You'll have projects where cash flows may have different patterns, but just to kind of introduce the concept to you, here is the timeline. And now you've done time value of money. So you know a timeline is a relationship between a cash flow and the point in time. So T0, where we're standing today, the business will invest 35, and at the end of the third year, we are hoping, expected, of course, that's a risk, that I'm going to get as business $67. Okay. Now, this is where business is, and business typically means, let's say, a Tata here. The project that I'm referring to is the EV battery plant. So a business may have multiple projects, and therefore they will have a multiple timeline such as this in their real life. But here we're just taking evaluation of one single timeline, one single project, such as the EV battery plant. Okay. Now the question is, where is this 35 going to come from? Business is actually an empty shell, like every other firm, every other company. It's an empty shell where money comes in from few suppliers, and those suppliers, the money that they give is put into some project. So the business is going to, on the other hand, speak to some other people. Let me pick up a blue color here and negotiate with them as to at what rate can they lend this $35 to them. So for a business, this 35 is going to be an inflow because you have to borrow. You see, I'm creating a separate timeline than my project timeline. So this one is going to be called as a borrowing timeline. The timeline means a relationship that I have with my capital providers. On the other hand, the timeline that I just had drawn in red color is going to be called as an investing timeline. People like Warren Buffett, investors of capital market, have investing timelines in their life, multiple investing timelines. So if whenever I buy a share, I create a timeline, investing timeline. Okay. But whenever I raise money to buy that share, I make a borrowing timeline. So at any point in time, business deals with two timelines on both the sides, the raising of the money and then deploying of that money. So going back to this borrowing timeline, the terms are the project can be financed by a borrowing, could be from equity, could be from debt, could be from preference, could be a joint exercise. We call it, let's say, a syndicate. We also sometimes refer to as a capital structure where different amount is coming from different sources. Here the terms are that I need to make payment of rupees 10 at the end of the first year, T1, let's say, and then finally I go to make annual payment. Oh, so there is one payment that I need to make at T2 as well. followed by the final payment of a 40. You see, now these are payments that a business have to make, and therefore I'll have to put a negative sign here. In corporate finance, signs have a lot of value. So here, that's how the two sides of the business looks like. Now you can also connect these two sides to the sides of the balance sheet. I'm trying to connect the world of accounting with the world of corporate finance. This side resembles very closely to the asset side of the balance sheet, whereas this side resembles very closely to the liability and the funding side of the balance sheet. And I'm sure that, in your trimester one, where fundamentals of accounting have been taught, the headings of the balance sheet was assets on one hand and liability and equity on the other. You know all this already. Many years ago, it wasn't like that. It was much more elaborated. So the asset side was called as application of funds, and the liability side was called as sources of funds. So you see, it was very descriptive and resonated very well with the concept of corporate finance. So you see, because in accounting and finance, both, you're dealing with the same entity called as a business. In accounting, you're just looking at the post factor side of this after the event has been done. And here you're looking at the discussion in terms of the futuristic expansions, etc. But at the end of the day, the structure of the business is going to be the same. So coming back to the concept of cost of capital, why is cost of capital required? So there is an evaluation that Tata Motors want to do. Should I invest this amount in this business or not? Now, there is some kind of a rate that we can calculate through mathematical jugglery. You and I have done this together within time value of money. There are multiple ways in which we have done this calculation of rate. So let's say I get an X percentage here. Okay. In the live class, we definitely will use Excel, you and I both together, and solve this question. And there will be a number that we will get out of this X. But right now, for the purpose of this discussion, let's say there is an X percentage on this timeline. Now, this is called as your rate of return. This is what the business is going to derive out of this. But is this enough? Is this sufficient? Is this be called, can the project be called as a profitable? Well, I need a benchmark to compare this X with. That benchmark really is your benchmark that you will calculate the rate on the borrowing timeline. Let's say we get a Y percentage. This Y percentage is the rate that the business have to pay to the capital providers. This is your cost of capital. The X percentage is your rate of return, sometimes also called as internal rate of return. So life is very simple, okay? The selling price have to be more than the cost price for a business to make sense. The rate of return has to be more than the cost of capital for this whole conundrum, the whole project to make money. The game is very simple. There is an opportunity to invest into battery plant, but Tata Motors did not have money. So they decided and they evaluated, they forecasted what will be the stream of cash flows. They found out that, they can invest a 35 today and they can get a 67 later. Okay, this is different for different people. This will change over a period of time, but standing at T0, these two estimates look the most reasonable. But then Tata realized that, 35 is what we need to evaluate because their money has an opportunity cost. So we looked at the opportunity cost, and the opportunity cost came out to be a Y percentage. Obviously, your current actions have to yield more than the opportunity cost. So again, by that common sense logic as well, X needs to be more than Y for this project to be said yes. So what we got to talk about in this business is what is the role of this cost of capital here. This cost of capital is your Y percentage, which is nothing but your rate of the borrowing timeline. Why do we require it? So that I can provide a benchmark on the investing timeline, the rate that I'm going to get out there. Okay. Remember, I shown you this slide in the almost at the fag end of one of the previous videos, and I'd also mentioned the point that you may not get a lot out of this slide then, but today is a time where you're going to derive a lot of it. Now, cost of capital, remember, we're talking about that Y percentage, the rate on the borrowing timeline. It is the opportunity cost. The was the opportunity cost used as a benchmark to evaluate the capital project, the battery plant, which was giving an IRR of X percentage. Now you are an MBA, okay? You must understand and you must develop a mental faculty to understand relationships between X and Y. It's not required that you must have a number here, like a 14 or a 13 here. All right. So try and learn and absorb these things in terms of X and Y as well. Y, as a second definition, is also the cost to finance the assets of the firm. And by financing the assets of the firm, I mean financing this 35 investment that you have to make today in order to operationalize the battery plant. So assets of the firm are these $35 that you have to invest today, okay, in order to generate a cash flow of 67 tomorrow. This Y, the cost of capital for the business, is actually the rate of return for the person who is lending it to me. So think of it. And this is what we discussed in one of the previous videos as well. When I give my money in form of an FD to the bank pays 7%. So that 7% is cost of capital for the bank, but the same 7% is rate of return for me, okay, the investor. So this Y is actually the IRR or the rate of return for the bank or the equity provider or the preference shares who are lending money to me. And finally, Y is the minimum rate that your project must earn. Obviously, X has to be as much high as possible compared to Y, but Y provides a break-even level. It's the minimum rate that your IRR of the project must be in order to your project to make some sense, right? So I will continue to bog you down with these 4 definitions till you really have appreciated this well. So like I said, it's going to be a short video connection of understanding of capital. Hope you have some strong handle now on what is a borrowing timeline versus what is an investing timeline. I can't wait to see you in the initial classes on corporate finance and this cost of capital. See you very soon.